I'm Brian Fowler, president of Blind Creek Resources Limited, listed on the TSX Venture Exchange, ticker symbol BCK. Blind Creek is focused in the Yukon, Northwest Territories, and British Columbia. The company's key property is the Blend Project, one of the largest undeveloped lead-zinc-silver deposits in Western Canada, plus plans to advance the recently acquired, fully permitted historic engineer gold mine in the Atlan District of Northwestern BC. Check us out at blindcreekresources.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Ross Kay. He's a home ownership consultant who works from thewealthyhomeowner.ca. Welcome back to the show, Ross.
Hey, thanks for having me back, Jim.
Some of the things now we're finding out with Vancouver's empty home tax, well, it's hitting people in homes that are not empty. We have the example of a midwife who lives with her husband on Salt Spring Island but comes into Vancouver 2-3 times a month and stays for a week or two at a condo that he owns in Vancouver. They've been slapped with this empty home tax, and she says it's going to cost them $7,800 a year, and yet very clearly you can tell by everything that's there that's her base of operations from when, she works in the Lower Mainland. Was this a poorly thought out tax?
I think the intent was good. The intent, Jim, was good. But this is once again people who don't understand how Canadians interact with their homes. So, you've actually brought up a really good problem that your listeners will not have even discussed or thought about, but something that your female listeners really should be aware of. The mere fact that this midwife and her husband are forced to own a matrimonial home in joint and claim that as their principal residence has limited the financial ability of female Canadians, normally wives and mothers, to gain high degrees of net wealth. Because the moment that you get married, you give up the ability to own 2 homes and receive lifetime capital gains exemption on both of them. I believe we talked about this maybe a year and a half ago. We talked on it, Jim. And people really don't know how devastating this part of Canadian tax law has been, mainly to women. Now, you can say, well, it's equally damaging to men. But that's really not how the familial relationships that I certainly was involved with over the last 30 years and the thousands of families, how it worked out. Generally speaking, and this is a broad-based generality, women always need to be protecting themselves when they get into a financial relationship with a man. That's just simply the way that it is. I can't count the number of cases where a divorcing couple, the matrimonial home, gets thrown into this big war, and the woman takes the children with her, and she leaves the house, mistakenly leaves the family home. And these are instances where we're not talking about violence or something like that. We're talking she just wants to get out of the house, and she leaves with the kids, only to find out that she can't get back into the house, and that the husband is allowed to own it, live there until their divorce comes through. That's really what you're talking about here with this midwife and the unintended consequences of this tax. Here we have, probably by the sounds of it, a legitimate reason for a family to own 2 properties. Certainly it's for income purposes. Now, I will also know, Jim, based on what you're outlining here, is my assumption is that these people are married, and my assumption is that they can only claim the non-Vancouver home as their principal residence. the property that they're holding in Vancouver that she lives in part-time, that will be subject to capital gains. So what they should have done with that property is they should have put in that property in some type of a rental, as a rental property, so at least they could have written off the expenses, like this unintended expense they're now going to have possibly with the vacant homes tax.
Ross, could the husband rent the house to his wife?
The husband and wife could rent the home back to the wife's, because a midwife, if I'm not mistaken, she will also have an independent business set up, so they could be leasing the property to the wife's midwifery business. So that would be a strategy that they should be looking at. Now, again, this is why everything that we do with the wealthy homeowner, we always involve other professionals. So she would need to talk to her accountant. She would need to talk to her tax professional. She would need to her and her husband would both need to be talking to their financial advisor. All of this conversation should be ongoing to find out what was the best strategy. But I would say, Jim, in all honesty, based on what you just said and what I've just communicated to your listeners here, the fact that she probably has to set up as a business, there's probably an opportunity for the two of them to have that property as a rental with the business would from them. That's probably a strategy that an accountant would have. That would make this tax, vacant home tax also deductible.
Now, Ross, another situation that's happened with these so-called vacant homes that are being taxed, people who've gone to hospital for a long period of time, their place is empty, and relatives have moved in, so they can visit that person in the hospital and look after their property while they're gone. Again, it's considered an empty house because it's not being rented.
Well, it's considered an empty house because the people who are they're not expressing themselves properly to the municipality. So that in that instance, Jim, those people are family members living in the home. There are in Canada, there are no laws that dictate what family members can and cannot live in your home. That the owner themselves living in the property does not make that your principal residence, does not determine whether or not that home is vacant. If your family members are living there, that qualifies as you occupying the house. Now, if the province wants to be foolish enough to take on the news media with financially harming a family where they have had a life-altering medical situation like you've described, well, so be it. Go ahead and try. But I can tell you that those people would be welcome to send me an email, and I would certainly cut something off for them, so that situation could be resolved very quickly.
Mm-hmm. What would that email be?
Well, it would address the principal residence.
Where would they send the email to?
Oh, they would just send it to rossk@rossk.com. They would do that through my Rossk Realty Consultants, the professional arm of our business. And they wouldn't have to get a membership in the Wealthy Homeowner to do something like that, Jen. This is a unique situation. It would be a letter that I would just have my secretary cut off for them.
Okay, Ross, we'll get into some more topics here about Vancouver real estate right after the break.
Hi, I'm Douglas Mason, President and CEO of Rainy Mountain Realty Corp., RMO, on the TSX Venture Exchange. Rainy Mountain's Brunswick property is located in the Rideout Shear Zone in Ontario, with grab samples running as high as 32 grams per ton gold. A follow-up drill program to test numerous targets located by recent groundwork is planned for early 2018. Please visit our website at rmroyalty.com.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia, Saskatchewan, and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the pink symbol ABN AF. surrounded by world-class gold deposits and mines. Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
Welcome back. We're speaking with Ross Kay. Ross, a listener was wondering if they should accept an offer from their bank to take a $1 million mortgage in order to buy a $1.4 million home in Vancouver. What would your advice be to someone asking that question?
Well, what my advice would be, it's going to depend on a long list of questions that they would have to answer. It would be rooted in 40 years of home ownership experiences that other people have followed, and it would also take into considerations the housing market, the housing stock, and I could just go on and all the different items that really should be involved in a discussion like that.
And what part of Vancouver?
Yeah, it sounds so simple.
Yeah,
the question, right? It sounds so simple, and the answers that have been given to every Canadian for the last 40 years has always been the same. It's never been the one we just sort of talked about right now. And I'm assuming the person who posed this question is expecting the same type of an answer, a quick one that was geared by the respondent's bias. And I am not biased. I am unbiased. I have a logical attitude about home ownership and about home ownership financing and about the net wealth that you can build in the family home. It is totally unbiased. I don't really care whether or not the people listening to me purchase a house or they don't purchase a house. What I care about is they make the best financial investment that they can, or financial decision that they can for them, and they build their own net wealth as best as they can for them over the next 40, 50 years. This young couple, I will tell you in all honesty, Jim, there will be lots of circumstances, where I would say to this I'm assuming they're a young couple when you're talking this way, that, you should go ahead and borrow the money. You really should, buy that $1.4 million house. And then Jim's going to say to me, well, but Ross, you're saying housing prices are dropping here, and there's 20 to 30% drop that we haven't even been recorded in the real estate metrics. And I'd say to you, Jim, but yeah, that's fine, Jim. But the way that you have to look at your home ownership situation, assuming you're going to own it for a long period of time, say 25 years or more, is totally different than someone who's going to sell their property and liquidate their real estate assets, or liquidate their real estate so they can get some of their home equity out in the next 5 years. It's two totally different things. And I'll explain it to you this way. The $1 million, when you said, Ross, $1 million of mortgage debt, you're going to hear comments about mortgage debt, about people putting themselves in debt, people financially constraining their lives because of mortgage debt. The banks, predatory lending. The banks are taking advantage of them. The realtors are taking advantage of them. Now, here on the show, I have told your listeners that that's true. But that still doesn't mean that a proactive home ownership plan, when you're able to purchase a $1.4 million home, may not be the best choice that you should make. I'll explain it to you this way, Jim. At today's interest rates, when I punch in $1 million mortgage, I come up with a calculation which is what the cost of that mortgage is going to be. And the cost of that mortgage is around $330,000. So the way that we approach home ownership is, we look at how much the mortgage is going to cost you. Not you repaying the principal, but the mortgage cost alone. And right now, using our methodology for calculating mortgage costs that has been reflective of what thousands of homeowners have experienced over the last 40 years, shows us that we're looking around $330,000 of interest to borrow that $1 million. So you're going to pay $330,000 of interest. Now, what your listeners need to understand is that's $330,000 in 2018 dollars. So the $330,000, by the time you've paid it off, that was in 2018 dollars, is going to be worth substantially less than that. Now, I'm not going to say a number off the top of my head because I'm sure I'll be wrong, but, I'm sure it's going to be less than 2/3 of that in real dollars as they've been paid off. Everything else that you pay on that mortgage is going to be principal, which is the same as a bank savings account. So the worst case scenario for this couple that you're talking about, they buy a $1.4 million home. 25 years from now, it's still worth $1.4 million, and the mortgage is paid off. Now, they're 1.4 millionaires. They're $1.4 million heirs. That's who they are 25 years from now. We also know that the house, even if it doesn't increase with the price that it should increase at, and there's a metric that we use for that, it's going to increase with inflation. So we know that at $1.4 million is in 2018 dollars today. 25 years from now will be in 25 years from now inflated value. That's going to happen no matter what. Now I'm going to tell you it's going to be more than that, but it's going to be that no matter what. So even if the house price has a 30-40% house price correction, dropping a 1.4 million down to 900,000, 25 years from now, that house will be back to at least its inflation adjusted number 25 years from now. That's just what's going to happen. So when it sounds so simple, the question, because when I look at my numbers, I also know that we're about $300,000 at 11% interest rate. That comes out to about $350,000 of interest. So back in 1990, if you had a $300,000 mortgage, you would have paid the banks about $350,000 of interest, plus the $300,000. So it's like apples to apples. It's like pears to pears. It's like pigs to cows. Each home ownership decision is different. There may be a lot of people out there right now who, if they had the qualifying income to take out a $1 million mortgage, because that's another issue we're not even talking about right now, Jim, because those people are going to have a qualifying income of about $180,000. Those are also people who have more disposable income, because even after their income tax is taken off, they are going to have a larger dollar number of their income than person who makes $100,000. So for those people to spend an extra $20,000 a year on the mortgage, it may be easier than someone who's earning $100,000 who has to spend $20,000 less. Each person's circumstance is different. How long they're going to own the home is different. What type of home are they buying? Which category of home are they buying? In what community is that home located in? What's happening with the development in that community? What is the provincial economic situation? What is their employment situation? All of these things really should go into the largest single financial investment that you're going to make. Because if you take out $1 million mortgage and you're going to have to pay $330,000 worth of interest, that means you're going to have to repay $1.3 million. Oh, by the way, didn't you say the property was worth 1.4? So, or I guess this discussion did. what we also know is that the purchase price of this property, the purchase price of the property itself is going to exceed the mortgage plus the interest cost. Forget the down payment, but the mortgage plus the interest cost. That is a very important metric for all of your listeners to understand. So in this case, Jim, that would be the answer to this $1 million. Should I take out a $1 million mortgage? Probably for 85% of your listeners, the answer would be no. 15%, it would probably be yes. And that could be as of today, February the 26th.
We'll have more with Ross Kay right after this.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Ross Kay. Ross, we have another $1 million question here, but this time it comes from your previous comment about foreign buyers in Vancouver and Toronto getting a huge discount in property taxes. What exactly are you referring to, and why is this not a hot topic with the mayors in Vancouver and Toronto?
Oh, why is that not a hot topic? And everybody wants to know what the little secret is. Okay, so what I'm going to say here on the show, you can search all over the internet, and you're not going to find what I'm going to tell you right now, Jim. And this is what's hilarious about these investor programs where people are spending hundreds and hundreds of dollars a month to be members of these investment networks. Go take your course with the guy from HGTV, all of these sort of things. Your listeners should understand this. If I am a Chinese buyer and the year is 2008, and I invest $1 million in the Vancouver real estate market. $1 million. I know, and then my buddy, 10 years later, in 2017, he invests $1 million in the Vancouver real estate market. So I purchased 10 years ago at $1 million. He's purchasing today at $1 million. Now, who do you think had to pay more property taxes than the property? It's $1 million, Jim. We're both spending $1 million. Who spends more money on property taxes?
Well, tell us.
Well, it's the guy who purchased last year. The foreign buyer who purchased in 2017. The city of Vancouver is giving the foreign owner a $1,756 discount if they purchase their home in 2017, if they invest $1 million in Vancouver real estate in 2017 versus 2008. It's a staggering number. Now imagine if it is a $10 million investment. 10 years ago, if you had invested $10 million in Vancouver real estate, you would have paid $43,000 a year in property taxes. $43,000. If you invested $10 million in 2017, you would have only paid, pop it up there, Ross, $25,000. The Vancouver municipal government has given you an $18,000 windfall by you waiting to purchase your Vancouver real estate in 2017. That windfall is going to be carried with you probably for the next 10 years. 10 years times 18,000 is $180,000. The reason why all of those housing measures that they brought into play last week, Jim, were only partial measures, which is what we talked about on your show last week, is that the governments, the politicians, the housing analysts, the academics do not understand how real estate is handled by the owners. Because the BC government did not bring in the full right to own policy, they only made it sound so great. They were increasing their land transfer tax, foreign buyer tax to 20%, 3%. Well, they're not compensating for the reduction in property taxes that the $10 million investor is getting in 2017 versus 2008. And in the years going forward, they are not going to adjust for that. This renders the 3% increase in the foreign buyer tax mute. It doesn't matter. It's why you needed to have a full right to own policy implemented to stop the risk of foreign buyers buying in your marketplace. Your listeners need to understand this. A $1 million property in 2008 paid $4,311 in Vancouver property taxes every single year. In 2017, 10 years later, after 10 years of inflation, they're only paying $2,554. The problem with the property tax assessment methodology, which is why it should never have been rolled out this way, it is based on a level playing field. It's based on everybody approaching home ownership in the same way. I'm just explaining to you how a foreign investor is reaping massive rewards based on the property tax structure. It works the same way for millennials versus boomers. It works the exact same way. So this inequality that they're talking about in some ways is right, in some ways it's wrong. It's just the opposite of what they're saying, because you have to look at each home ownership situation in its own cone, under its own cone, its own variables that are impacting that ownership structure. I've just explained to you how a Chinese investing in 2008 versus 2017 can make $180,000 gain. Like, it's staggering the amount of money that we're talking about. But because your politicians, your academia, your housing analysts, CMHC, they couldn't explain how your housing prices increase what they increase. It's just the reason they can't explain it is they don't understand how the homeowner interacts with their home. They don't understand what I just said about property taxes being at $4,300 in 2008, dropping to $2,500. Property taxes did not stay level. Property taxes dropped. And I know what all your listeners are thinking right now. Well, wait a second, Ross. My property taxes have, just basically gone up with inflation. Some years the municipal government holds the tax line and another years that they raise it. It's the assessment that goes, yes, you are 100% right. The assessment goes up. It's the tax on the investment that changes. The tax on your home doesn't change. The tax on your home equity does. And it's the tax on the foreign owner's home equity, which has plummeted. Their invested dollars continue to grow, and the property tax they're paying stays the same. effectively being reduced each and every year that they own their home. Now, your listeners need to go out there and start Googling, checking academia, find somewhere else in the world where what I just said is published. They won't find it. It doesn't exist. The truth is, if you invested $1 million in Vancouver real estate in 2008, you would have paid $4,311 in property taxes. If you invested $1 million in Vancouver real estate in 2017, you would have only paid $2,554. And that's in 2017 dollars, not 2018. You are paying less than 50% of the property taxes that you used to pay in 2008. And that's when this $1 million discussion comes home. This is why CMHC can't explain the change in the property. And they property prices between 2010 and 2016 in that 200-page report that they did. Because they don't take this into consideration. And the other plethora of items that they need to take into consideration. Your listeners don't take it into consideration until they're 65, 70 years old. And they're looking at their bottom line in their home and they're saying, wow, where did all that money go that we thought we were going to have? Well, it's because you left it in your house. You didn't do anything else with it. Well, yeah, why would I want to do anything else in my house? Everybody tells me to pay off my mortgage as quickly as possible. Well, for most people, that's the worst advice you can give them. Now, you can't trust a financial advisor doing that because they're just going to say, borrow, and we'll invest so I can make more, a higher profit off of the stocks that I get you to buy and sell. You can't do that with a mortgage broker because they just want to make the commission off the mortgage that they get you to post. You can't do that with the bank because the bank's going to use every single trick that they can to get as much money out of your pocket. Now, you could talk to your accountant, but accountants really like to have the facts laid out before them so that they can give you a yes or a no. The accountant really doesn't want to come up with a strategy or a plan. They would rather give you an opinion on the strategy or plan someone else gives. I have just explained why a $1 million investment in 2017, you're paying less than 50% of the property taxes than you were in 2008 dollars. That's the kind of advice that your listeners need to have. That's the kind of advice the governments need to have. The governments cannot institute policies unless they understand how the housing infrastructure operates, and they have no idea, as do any of these economists that I see in the newspapers all the time, any of these housing analysts, and you know they don't, because what I just told you, you will not find published anywhere.
Ross, thank you so much for chatting with us.
Hey, thanks for having me on, Jim.
My guest has been home ownership consultant Ross Kay from thewealthyhomeowner.ca. You're listening to HowStreet.com radio. Find us on Twitter at HowStreet. Our popular YouTube channel is Talk Digital Network. Questions for the show or our guests can be sent to info@HowStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.